Good morning. Welcome to Stock Market Today. It's Monday, November 2nd, 2020, and I am your host, Dan Russo, the Chief Market Strategist at Chaikin Analytics. You can find me on Twitter at Dan_Russo_CMT. Stock Market Today brought to you today and every day by Chaikin Analytics. Head over to chaikinanalytics.com/today. Sign up for a free email where I get a lot of the content for this show, as well as we give you daily stock ideas to consider that hits your inbox every trading day before the market opens. So I hope everybody had a great weekend. Now let's get going on what is likely to be a busy week. U.S. equities fell on Friday, but closed off the lows of the session thanks to a late rally. The S&P 500 and the NASDAQ both logged their worst weekly performances since March. Treasuries were mostly weaker with the curve steepening, and that was an interesting dynamic at play throughout last week. The dollar was stronger against the euro, a little changed on the yen cross. Gold was up 60 basis points on Friday, and WTI crude closed down 1.1% and dropped more than 10% on the week. We'll take a look at what that looks like a little bit later on in the show. Our leading sectors on the day: fins, energy, and healthcare. Underperformers were discretionary and technology. Remember, it was Friday morning after we heard the earnings announcement from those big market generals, and those reports were generally not well received as the earnings bar continues to move higher. As we get to the desk this morning, S&P futures are up about 1.3% after that big decline last week. Asian markets were higher overnight. Japan, South Korea, and Hong Kong all up over 1.5%. European markets are rallying as well after a big sell-off last week. Treasuries are weaker once again, with the curve continuing to steepen. The dollar a little bit stronger on the major crosses. Gold is up 40 basis points. WTI crude down 2.2% after that more than 10% decline last week. So that is the framework that brings us into Monday morning on the day before Election Day here in the U.S. And the major market averages, to be perfectly fair, they were under pressure last week. It was an ugly week. There's no two ways about it. But the key levels that we've been highlighting remain in place, right? So if we think from a big picture perspective, if we zoom out to the bigger picture trend, it was weak last week, but the trend didn't really change, right? We had a late surge. It was the worst week since March. But if we take a look at the SPY, we're holding above that key 320 support level. To the upside, 340, though, now becomes interim or near-term resistance. As we look at the Qs, same story, 260. Key support to the downside did hold. 280 now resistance to the upside. And for IWM, call it 140 to 145 as support, with resistance kind of cropping up in the 165 to 170 range. All three of the major market ETFs by our work remain oversold. So a lot of back and forth. We've been highlighting the fact that it's likely going to get noisy from a headline perspective. That portion of the dynamic has not disappointed over the past couple of weeks. The headlines have been there, but the bigger picture trend does remain in place across the board, right? So we're going to have the election. Who knows how it's going to play out, right? We really don't know, especially if we use 2016 as a framework. We know that, the polling numbers might not necessarily be telling the whole story. I don't know. I don't have an opinion there one way or the other. I kind of am viewing the election much like I view earnings. It's not so much what happens, but the market's response to it. So we know our support levels. We know our resistance levels. That is a near-term roadmap as far as I'm concerned. And then based on how the market reacts around the event. And remember, we have events this week. We have the election. We also have a Fed meeting and the jobs report on Friday, right? Fed meeting Wednesday, Thursday, jobs report on Friday. So definitely going to be a headline-driven week. So just kind of have your framework, know your levels, manage risk. So essentially the same thing you would be doing no matter what week of the year it is. At least that's my view on how to frame things up coming into this week. Now, as we look at our market in a minute, what are we writing about in our note today? Well, that late stage rally on Friday, but we did still close much lower on the week. Treasuries were interesting because they failed to provide a haven and remain under pressure. Oil weighs on the commodity complex, which is now testing support. The commodity complex is testing support. We'll take a look at oil a little bit later on. Dollar moves higher and holds its inverse correlation to risk assets. And that's been something that's been in place since March. As the dollar has moved down between March and August, risk assets rallied. And as the dollar has been in a consolidation for the past few months, so have risk assets. So an important chart to continue to focus on is the US dollar. Futures, as I said, point to a higher open here today. Let's take a look at the major indices from a power bar perspective. No two ways about it. We can't sugarcoat the fact that this deteriorated over the course of the past week. Dow lost 52 basis points on Friday, 1-8 bulls to bears. S&P down 1%, 85 to 125 bulls to bears there. NASDAQ took the brunt of the damage with those earnings reports. 13 to 22 bulls to bears. Small caps, the only group with a bullish ratio at this point. Down 1.3% on Friday, 626 to 333 bulls to bears. And there's the bonds. Really interesting, right? You see all that red in the equity market. You'd expect to see bonds providing some sort of a haven, and they did not. Down 1%, sending yields higher. We'll take a look at the 10-year a little bit later on in the show. According to the Chaikin Power Bar, small cap stocks are more bullish than large cap stocks, and the major indexes across the board remain mixed. Let's hit our stock of the day now. Freeport-McMoRan. So this is a name that we liked back in the June-July timeframe when it was trading between $10 and $12. It's now gone into a bit of a consolidation here in the near term, and I think it sets itself up, especially in light of my views on inflation. Stock has a bullish Chaikin power gauge rating. The trend is strong as the stock trades above the rising long-term trend line as part of a strong industry group. As we look at the power bar for the metals and mining industry group, it is strong. As we take a look at the bottom of the chart, we can see the ribbon at the bottom of the screen. We've been bullish since June, and shortly after turning bullish, the stock began to outperform the market. And what's interesting is we're actually seeing some highs now in the intensity of outperformance. If you take a look here at this heat map, you can see it's pushing to the upside once again. Money flow is mixed. Stock is entering an oversold position. Now, if we've learned anything over the past few cycles, it's the fact that markets or stocks, when they enter oversold conditions, can continue to be oversold for a while, right? The major market ETFs entered last week coming into an oversold position and remained under pressure. So depending on how you look at it, your level of aggression, perhaps the best thing to do sometimes is to wait for that overbought, oversold indicator to begin to round higher within that oversold position. But I wanted to point it out. I think it's interesting here. Depending, you kind of have to know yourself at this point. Are you more aggressive or are you a little bit more conservative? And that might determine when you take action in a stock like this. But I do think the trend here is interesting. We're oversold within the context of an uptrend for a leading stock in a leading industry group. So I'm highlighting Freeport-McMoRan in my note and here on the show today as a potential idea. Let's look at our sector tracker now. The movement of the major sectors over the last 5 days. Utilities and REITs at the top of the list. Your yield plays, which is kind of interesting because bonds have been selling off. Materials and comms round out the top 4. Staples, energy, fins are middle of the road. Healthcare, tech, industrials, and discretionary at the bottom of the list. Right, so we have a lot of macro, we have a lot of micro driving the near-term trading. All sectors lower over the past week, which kind of coincides with the fact that the S&P and the NASDAQ just logged their worst weeks since March. So I'm not surprised to see a sea of red in this column of sector movement over the last 5 days. The question is, where is the leadership? And quite frankly, right now it's in the utilities, which is kind of interesting. But again, maybe jiving with the fact that, number one, it's hard to get yield in the Treasury market. And number two, the utilities do possess some defensive properties as we come into what could be an eventful week. All right, so just things that we're keeping in mind as we kind of run through our process here on a Monday morning. Our industry in focus is the REIT services group. So speaking of which, they're number 2 over the past week. But if we take a look at the group itself, I mean, been an underperformer against the S&P 500 by about 5% over the past 6 months, and has a really weak power bar ratio. 57 bears to 6 bulls, and it's the lowest rank of the 21 subsectors we look at, having moved down 1 slot over the past week. So some of the names there we certainly want to avoid: QTS, QTS Really Trust, ADC, Agree Realty Corp, and Avalon Bay Communities, AVB, all with very bearish Chaikin power gauge ratings, all holdings in an ETF that looks like this, right? I mean, the best thing that we can say is, at least we haven't tested the March lows yet. The rating on the fund is very bearish. The trend is weak as the fund trades below the declining long-term trend line. Look at the underperformance. The underperformance is kind of interesting because it's been there for well over a year, right? It wasn't just simply, coronavirus is upending the REIT space, right? No, it accelerated a move. but that move was already in place. That underperformance was well established. Now, the fund has a bearish rating, as I said. So what do we have? We have a bearish fund that's underperforming the market, right? It is oversold here in the near term with some mixed to slightly bullish money flow, but it's really hard for me to get excited about this group. Maybe the tables turn. I don't know. We would see signs of it here, though. All right, we'd see price start to move higher. We'd see an improvement in relative strength, and thus far, that is not the case. Let's take a look at what's trending. Yesterday's movers and shakers, or Friday's movers and shakers. Seem to do that every Monday morning. The gainer side of the board, Mohawk earnings sent that stock higher by nearly 11%. RMD, ResMed up 7%. On the heels of their earnings announcement, and they did catch a bunch of upgrades after that earnings report. Devon Energy up a little over 5.5% following their print. Molson TAP, Molson Coors, 5.6% to the good on the heels of their print. And then Carnival Cruise Line, not earnings related, up 5.6% as CDC begins to lift cruising bans. The loser side of the board is all earnings related. Twitter, I just can't seem to get it going. Sometimes they show good user growth, but poor revenue growth. Sometimes they show poor revenue growth and better user growth. Can't seem to connect the two. Stock down 21% on Friday following their print. Etsy reported on the 28th, some follow through to the downside there, down 8% on the day. ADM, this was actually a name that I liked, so mea culpa on my part. Part of the agricultural theme, well, their earnings report were not enough. Stock down 7.4%. Lumina, ILMN, earnings sent that stock down by 7%, very bearish rating, and bearish rated Western Union was down 7% on the heels of their earnings announcement. And we still have a busy week of earnings this week with everything else that's going on. So, the macro and the micro continue to collide here in the near term. So let's get into the charts. We talked about the equity markets already in the major ETFs, and we predominantly focus on equities throughout the week, which is why on Mondays I like to look at some of the bigger picture cross-asset trends. And certainly one that catches our attention here on a Monday morning is the 10-year yield continuing to back up. Remember, yields move inversely to prices. So as yields have moved higher, Treasury bond prices have moved lower, which is interesting because we just had our worst week in equities since March, but you couldn't hide out in Treasuries. I could not hide out in the Treasury landscape as those were under pressure as well. If we take a look at the 10-year here, just strictly from a technical perspective, after moving through the 50-day moving average, the 50-day moving average in blue is now rising. And then last week we move above the 200-day moving average, which is still declining in fairness. I think there's this peak at 90 basis points that if broken, we have to certainly consider the trend, at least in the near term, to the upside. And that's actually confirmed by what we're seeing in the RSI. Take a look at the RSI at the bottom of the chart. Shifting higher, a series of higher lows, and now ultimately a shift into a bullish regime. So to the extent that we hold a bullish regime and yields continue to move higher, you have a change of trend confirmed by momentum. So really an interesting dynamic there. And I think additionally, if we kind of want to bring this back to equity markets, it's part of why I think you're seeing the growth theme under pressure right now, right? Remember the growth over value chart. Go back to the chart that we show every Friday. Peaked the end of August, right? And we said we didn't want to chase it. It's gone into a consolidation, and that underperformance now in growth in the near term is coinciding with yields backing up. And if you think about why that is, time value of money dynamics begin to come into play. Higher rates generally a headwind for growth stocks. So just something to kind of keep in mind as we bring this back to the equity portion of the conversation. Oil under pressure. Now, we've been saying it for a while in our notes that we thought that, failure to get much above 40 opens the door for a move back down to the low 30s, and that appears to be playing out. Oil down 10% last week, below the 50 and 200-day moving averages and remaining below resistance, all while the RSI holds within bearish ranges, and energy continues to underperform at the sector level relative to the S&P 500. You know how I feel about energy. I'm intrigued. The sentiment could not be worse, but the trends are just not there for the way that I look at markets. So continue to be a group to avoid. And then finally, gold and the dollar. Here's gold rolling over. Right, we're looking for a move potentially down to 1,800, but I think everybody is looking for that as a key support level. But we are below the 50-day moving average, above the 200-day moving average for the yellow metal. And you can see the 200-day moving average beginning to get to that 1800 support zone. And that's all playing out as the dollar has bottomed and started to move higher. So that inverse correlation continues to hold. That'll wrap us on a Monday, folks. Have a great day. Great start to the week. I'll be back with you tomorrow.